Okay, let's just try and unpack this. Imagine you're a business leader in Accra right now.
Hmm.
You could be a CEO, a regulator, maybe you're just someone who watches the Ghanaian economy, with the intensity of a hawk.
Right.
You wake up, you get your coffee, and you check the headlines. And on the surface, it just looks like a spreadsheet came to life. Numbers flying all over the place, debt's down, bond turnover is up, banks are rewriting their playbooks.
It does sound a bit dry when you just list it out like that, doesn't it? Just a soup of percentages and billions.
Exactly. It feels like data overload. But here's the thing, if you look closer, if you actually connect the dots, there is a massive narrative unfolding this week.
Yes.
We have a government tightening its belt, a bond market that is suddenly hot again, banks that are, well, desperate to lend but terrified of risk, and this tug of war over the price of fuel that could change your operational costs tomorrow.
You're absolutely right. It's one of those weeks where if you only read the headline, you really miss the actual story.
Yeah.
The narrative isn't in one single data point. It's in how these different sectors, fiscal policy, the bond market, the banking halls, are starting to talk to each other in a whole new language.
And that is exactly why we're here. Welcome to a special edition of the Deep Dive. Today, we are focusing on the Yield Era News Review analysis.
And we're going to do sort of a forensic audit of the top news items that were reported by major networks here in Ghana between January 26th and January 30th, 2026.
Our mission today is simple, but I think critical. We want to take these isolated stories and figure out what they mean for you.
For you, yeah. Whether you're sitting in a boardroom, managing a family business, or just trying to figure out if now is the right time to expand.
Now, before we jump into the numbers, and trust me, the numbers this week are genuinely fascinating, we have to give credit where it's due.
Hmm.
This analysis is brought to you by the courtesy of the Yildera Policy Institute, and we are proudly sponsored by Metis Decisions Limited.
And Metis Decisions is a premier strategy and governance consulting firm based right here in Accra. And frankly, given the complexity of the landscape we are about to discuss,
Right.
if you're listening to this deep dive, you probably need a partner like them. They specialize in the heavy hitting stuff: corporate governance training, strategy advisory, and board evaluation.
They also handle the really technical heavy lifting. We're talking ICAP and stress testing program design, enterprise risk management systems design, and AML risk assessment tool design.
Basically, all the things that make your organization robust.
Yes. Basically, if you want to bulletproof your organization against the kind of shifts we're talking about today, you need to talk to them. You can find them at metisdecisions.com or just drop them an email at info@metisdecisions.com.
So with that essential context set, I think it's time to get into the meat of the week.
Let's do it. Let's start with the macro view. The big headline that hit every screen this week was about public debt. And for the first time in what feels like ages, the arrow is pointing down.
It is
We saw a significant drop.
a very significant one. We're looking at data released by the Bank of Ghana this week, specifically covering the period between September and November 2025.
Okay.
In that narrow window, Ghana's public debt reduced by 40 billion cedis.
40 billion. That is not pocket change. That is a serious chunk of change.
Not at all. That brings the current stock down to 644.6 billion cedis. Now, raw numbers can be hard to visualize, so let's put that in perspective for you.
Please.
That represents approximately 45.5% of GDP.
Okay, 45.5%. I remember times not too long ago when we were looking at debt to GDP ratios that were much higher.
Oh, much higher.
It felt like the ceiling was collapsing,
Yeah.
so this feels manageable. But help us break this down. Is this just a currency fluctuation magic trick, or did we actually pay down debt?
It's a mix, as these things usually are,
Yeah.
but the breakdown is really telling. The domestic debt dropped to 314.5 billion cedis,
Well,
which is about 22.2% of GDP. External debt, the money we owe to foreign creditors, is sitting at 29.3 billion US dollars, or 23.3% of GDP. But here's where it gets really interesting if you look at the fiscal operations data.
I know you love the fiscal operations reports. What stood out to you?
It's the primary balance. So we saw a fiscal deficit of 1.4% of GDP, which is, standard, but we achieved a primary surplus of 2.8% of GDP.
Okay, let's pause there. Primary surplus. That's one of those economist terms that gets thrown around on the news.
It is.
For the CEO listening who is more focused on sales targets and EBITDA, translate that. Why is a primary surplus of 2.8% such a big deal?
It matters because it measures the government's discipline.
Mm,
Think of it like a household budget.
okay.
A primary surplus means that if you ignore the interest payments on your old credit card debt for a moment, the household is actually earning more money than it's spending on groceries, rent, and school fees.
So on a day-to-day basis, they aren't bleeding cash.
Exactly. They are living within their means regarding current activity. It suggests that the government isn't borrowing more just to keep the lights on or pay salaries,
It's a strong signal.
a very strong signal of fiscal effort and credibility.
Yeah.
It tells the market, we are serious about fixing this.
Which is exactly what investors need to hear. But I noticed a nuance in the report. While the CD debt dropped, the dollar value of the total debt did fluctuate a bit.
Yes, you have to watch both hands. While the CD value looks great, the dollar value of the total debt stood at $57.2 billion in November 2025.
Okay.
That was actually up slightly from September, though down from October.
Yeah.
So the external environment is still shifting. Currency fluctuation plays a role here.
Sure.
If the CD strengthens or weakens, that dollar figure dances around. But the core story, the domestic consolidation, that's real.
And that consolidation seems to be feeding directly into market sentiment. Which brings us to our second segment, the bond market. Because if the government is getting its house in order, usually investors start sniffing around to see if it's safe to come back in the water.
And they are doing more than sniffing around. They are buying. We saw data from Joy Business on January 27th, 2026, showing that the secondary bond market is really heating up. Turnover was up 14.7% week on week.
That's a total of 5.29 billion CDs in turnover for just 1 week. That feels like liquidity is finally coming back.
It is.
But I'm curious, where's the money going? Are they buying everything across the board, or are they being picky?
Oh, they're being very specific. And this is what we call playing the belly of the curve.
The belly of the curve. It sounds comfortable, but I assume you don't mean they're just relaxing.
Not at all. Think of the yield curve like a timeline. You have the short end bonds expiring soon. You have the long tail bonds expiring in, say, 15 years.
And the belly is the middle.
The belly is the middle. Right now, investors are rotating heavily toward maturities between 2031 and 2034. That segment captured 51.6% of the traded volumes.
Wow. Over half the market is betting on that 3 to 4 year window. Why there? Why not go really long if you're confident?
It's a strategy of optimization. They're getting a weighted average yield of 15.63% in that belly. And if you want to know the superstar of the week, it's the February 2031 benchmark bond.
Just that one bond.
That single bond accounted for 2.29 billion CDs of the total volume.
So everyone wants a piece of 2031. But what about the short term or the really long term?
It's the short end, so the 2027 to 2030 bonds took about 41.2% of the flow, but the yield is lower, around 14.70%.
Okay.
But the long end, the 2035 to 2038 maturities, it's a ghost town, only 7.1% of activity.
They're sidelined. So investors are confident enough to go out to 2031, but 2038 is still a bridge too far for them right now.
Exactly. It says we trust a recovery, but let's not get ahead of ourselves.
Mm.
But there was another driver here.
Oh.
Analysts are pointing to portfolio rebalancing. We have a monetary policy committee meeting on the horizon.
The MPC. Always moving the markets.
Precisely. Investors are positioning themselves. They see that yield of 15.63% in the belly of the curve, and they are thinking, I want to lock that in before any potential policy shifts change the landscape.
So let's make this practical. If I'm a corporate treasurer listening to this, say I manage the cash for a large manufacturing firm in Timoman, what does this mean for me?
The key takeaway is liquidity. The rising turnover suggests that the market is functioning again. If you need to liquidate positions or move cash around, there are buyers.
The gears are greased.
The gears are greased. That reduces your risk significantly.
And that liquidity in the bond market transitions us perfectly into the banking sector, because this is where the rubber meets the road for the wider economy. If yields are compressing, getting smaller banks have a serious problem, don't they?
They certainly do. It changes their entire business model.
Right. If I'm a bank, and for the last few years I made easy money buying government bonds at sky-high interest rates.
Just sitting back and collecting coupons.
Yes. And now those rates are dropping, and the government is borrowing less. How do I make money?
That is the billion CD question. And we have a report from Fitch Solutions, also from January 27th, that it addresses this head on.
Okay.
First, the good news. The closure of the Domestic Debt Exchange Program, the DDT, has largely restored capital buffers for Ghanaian banks.
So the crisis is over.
The immediate crisis mode is over. They have the money.
Okay, so the vault is full. But Fitch pointed out a pretty big fly in the ointment regarding profitability.
Yes. the non-performing loans, or NPLs. In October 2025, NPLs stood at 9.5%.
That's high.
That is elevated. It acts as a massive drag on profitability because you have to set aside money to cover those bad debts. You can't use that capital to generate new revenue.
So you have capital, but you have a history of bad loans. And now your favorite investment risk-free government securities is becoming less attractive.
And less available. This is the aha moment for the private sector.
Yeah.
Historically, Ghanaian banks held anywhere from 20% to 35% of their total assets in government securities. It was safe, it was high yield. We call this crowding out because the government sucked up all the available money.
And now crowding out is ending?
Precisely.
Oh.
The government is consolidating, they're borrowing less domestically. Fitch forecasts that in 2026, loan growth is going to accelerate.
So what does that mean?
It means banks will be pressured by the need for returns to redeploy their capital into private sector lending.
This is huge. If you're a business owner, this is what you've been waiting for.
It is.
The banks need to lend to you to make their numbers work. They can't just sit on the cash.
Yes, but let's connect this back to the risk profile. Banks want to lend, but they are staring at that 9.5% NPL ratio.
Yeah, huh?
So while credit availability is expected to improve, the scrutiny on borrowers is going to be intense. They need to lend, but they cannot afford to lend to the wrong people.
So the tap is opening, but the filter is going to be very, very fine.
That is a perfect analogy. The days of easy application approvals are not coming back. You need to prove you are a safe bet.
Let's switch gears now. We've talked about money debt, bonds, loans. Now let's talk about something tangible that affects every single business's operational costs. Fuel.
The petroleum sector. And this is a fascinating story. There is a regulatory battle, or a tug of war, as it was described in the press, happening right now.
A tug of war over what?
Over something called the petroleum price floor.
I read about this in the Ghanaian Times this week. It sounds like the industry is split right down the middle.
It really is.
You have the Chamber of Oil Marketing Companies, COMAC, seemingly at odds with itself, and then the regulator and consumers are jumping in. What's the core conflict here?
The core issue is whether there should be a minimum price below which oil marketing companies cannot sell fuel.
A price floor.
Right. Dr. Riverson Alpong, who's the CEO of COMAC, describes this as a minimum benchmark. Now, he frames this carefully. He argues that this isn't just about protecting profit margins for the oil companies.
What's the argument then?
His argument is that if prices go too low due to destructive undercutting, two things suffer: product quality and government revenue.
Explain that connection for me. How does a low price lead to bad quality?
The logic is that if you are selling fuel cheaper than it costs to import and distribute, you must be cutting corners somewhere.
Okay.
Maybe you're adulterating the fuel, mixing it with something else. Maybe you're evading taxes. He's saying a price floor prevents that race to the bottom.
So he's framing it as a quality control measure. And interestingly, the regulator, the National Petroleum Authority, or NPA, they agree.
They do. Abbas Dasunti from the NPA was quite clear. He says the price floor is necessary because unfair pricing practices and distortions are still threatening industry stability.
So they're not removing it.
They will not remove it yet.
But not everyone is buying that argument.
No. Enter the critics. Duncan Amoah from the Chamber of Petroleum Consumers is arguing that this defeats the entire purpose of the price deregulation policy.
Which makes sense. If you deregulate to let the market set the price, but then you set a minimum price, are you really deregulated?
That is the friction. The consumer and the business with a fleet of trucks wants the lowest possible price the competition can provide.
Of course.
The industry and the regulator are arguing that lowest possible comes with hidden costs like instability or bad fuel that we just can't afford.
And for a business listener, this implies that while we might not see massive price spikes, we also won't see prices bottom out.
Exactly.
Operational costs for logistics and transport are being artificially held at a kind of stability baseline.
Exactly. It removes some volatility, but it also removes the potential savings from a fully free market.
So let's try to synthesize all of this. It's been a heady week for news.
A lot to cover.
We have a government that has managed to cut its debt and run a primary surplus, signaling fiscal discipline.
Which has triggered a rally in the bond market, specifically in that 2031-2034 timeframe, showing investor confidence is returning.
Which, in turn, is forcing banks to look away from government paper and back toward the private sector, meaning 2026 could be the year of the business loan.
All while the energy sector, the very engine of the economy, is being carefully managed with price floors to ensure stability, even if it stifles some competition.
It paints a picture of an economy that is stabilizing, maturing, and pivoting toward private sector growth. But, and there is always a but, isn't there?
Always.
It requires businesses to be ready.
And that raises a really important question for our listeners. We established that banks are under pressure to lend to the private sector to maintain their profits.
Right.
But we also established they are terrified of non-performing loans.
So the money is there, but you have to prove you aren't a risk.
Exactly. So here is the provocative thought to leave you with. With banks pivoting away from safe government securities toward private lending, is your business governance and strategy robust enough to attract that capital?
That's a great question.
When the bank manager looks at your books, your board structure, and your risk management, will they see a partner or will they see another NPL statistic?
That is the million-dollar or billion-seedy question. You can't just ask for money. You have to look like you can handle it.
And that brings us right back to our sponsor. If you're asking yourself that question and you aren't 100% sure of the answer, you probably need to talk to Metis Decisions Limited.
They are the experts in getting you ready, whether it's strategy advisory, board evaluation, or designing those enterprise risk management systems that banks love to see. Visit them at metisdecisions.com.
This has been the Yield Era News Review Analysis.
Thank you for diving deep with us. We'll be back next week to see if that bond rally holds and if the banks really do start opening the vault.
Until then, stay informed.
Goodbye.